Have you ever loaned money to a trusted friend knowing they'll pay you back with a little extra on top? That's the basic idea behind bonds. Welcome to Do Academy. Today, we're delving into the world of bonds, exploring their types, benefits, and how they can contribute to your financial goals. Bonds are essentially IOUs issued by governments and corporations offering a unique combination of stability, income, and diversification within your investment portfolio. At the heart of a bond lies a simple concept: a loan. You, the investor, act as the lender, providing a specific amount of money to a borrower, either a government or a corporation. In return, the borrower promises to repay you the full principal amount at a predetermined date, known as the maturity date. But this repayment isn't without a reward. Throughout the life of the bond, you receive regular interest payments, essentially a thank you for your financial support. These interest payments are typically fixed, offering a predictable source of income. The world of bonds isn't a one-size-fits-all scenario. There are various types available, each catering to different risk and return appetites. Let's explore some of the most common ones. Considered the gold standard of safety, government bonds are issued by national governments. They are backed by the full faith and credit of the issuing government, making them the least likely to default. While they offer low potential returns compared to other bonds, they provide peace of mind for risk-averse investors seeking stability. Issued by companies to raise capital for various projects, corporate bonds offer a higher potential return than government bonds. However, this higher reward comes with increased risk. If a company encounters financial difficulties, it may default on its bond repayments, resulting in a potential loss for the investors. The creditworthiness of the issuing company significantly impacts the risk associated with a corporate bond. These bonds are issued by local governments like cities or states to finance public projects like schools or infrastructure. They often come with tax-exempt interest, meaning investors don't have to pay taxes on the interest earned. This makes them attractive to those seeking income with a tax advantage. So, why should you consider incorporating bonds into your investment strategy? Beyond the basic loan structure, bonds offer several benefits that can significantly impact your portfolio's health. Unlike stocks, where prices can fluctuate widely based on market sentiment, bonds generally experience smaller price swings. This characteristic makes them a stabilizing force within your portfolio, particularly during periods of market turbulence. By adding bonds with varying maturities, you introduce an element of stability and help manage overall portfolio risks. Bonds provide a predictable stream of income through their fixed interest payments. This income source can be crucial for retirees or investors seeking a steady cash flow to meet their financial needs. Bonds have a different risk-return profile compared to stocks. Including them in your portfolio allows you to diversify your holdings, a fundamental principle of successful investing. Diversification helps spread out your risk across different asset classes, mitigating the impact of any single investment experiencing a downturn. While we've explored the fundamental concept of bonds, there are more key features that may influence your bond investment decisions. While fixed-rate bonds offer predictable income, there are other types with more variable interest payments. For example, floating-rate bonds adjust their interest based on prevailing market rates, providing some protection against inflation. Zero-coupon bonds, on the other hand, don't pay regular interest but are sold at a discount and redeemed at maturity for their full face value, offering a capital gain upon maturity. When it comes to corporate bonds, understanding credit ratings is crucial. These ratings, assigned by independent agencies, assess the issuer's ability to repay its debt. Higher ratings signify lower default risk and translate to lower interest rates. Conversely, lower ratings indicate a higher risk of default and offer investors a higher potential return to compensate for that risk. The maturity date of a bond significantly impacts its price and the interest it offers. Generally, bonds with longer maturity come with higher interest rates to entice investors to lock in their money for a longer period. However, these bonds are also more sensitive to changes in interest rates. If the market interest rates rise, the price of existing bonds with lower interest rates tends to fall. The world of bonds extend beyond government, corporate, and municipal offerings. Convertible bonds offer the potential for capital appreciation by allowing investors to convert their bonds into company stock under certain conditions. High-yield bonds, also known as junk bonds, offer significantly higher returns but carry a greater risk of default. These are suitable for investors who are comfortable with a higher risk profile. When incorporating bonds into your portfolio, consider your investment goals and risk tolerance. Younger investors with a longer time horizon can typically tolerate more risk and may include a higher percentage of corporate bonds or high-yield bonds for potentially higher returns. Conversely, those nearing retirement may prioritize stability and opt for a larger allocation of government or municipal bonds with lower risk profiles. Understanding the different types of bonds and their unique characteristics empowers you to make informed decisions about incorporating them into your portfolio. Remember, a balanced portfolio is key to achieving your long-term financial goals. So, are you an investor who prioritizes steady, predictable income? Or are you more comfortable with the potential for higher returns, even if it comes with a bit more risk? Share your thoughts in the comment section below. Be sure to like, share, and follow Do Academy for more actionable investment insights.